Do you ever find yourself planning trades that you never execute and executing trades that you never planned? Welcome to Trading Without Fear. This episode, I'm going to be discussing planning trades and how to execute the trades that you've planned. So what does a trade plan mean to me? A trade plan, what it means to me is a predetermined criteria or pattern that I'm looking for in the market. The criteria is backed up with data or experience that I have in the market. So what I do is I create a watch list the night before. Some people prefer to do it in the morning, and that's okay if that's your preference. And so what the watch list does is it gives you an idea of what has a higher potential to formulate a specific pattern or a specific criteria that you're looking for that gives you an edge in the market. Another thing that a lot of kind of newer traders or people don't really take in consideration is time of day. And it's not just like what your day looks like, what your schedule looks like, but it's also what the time of day the pattern does. If you ever track the patterns and kind of figure out when that time they form, depends on the patterns, they may be better at certain times of day. So a morning panic dip buy is better in the morning, so pretty much as soon as market opens. If you're looking for a panic at any time frame throughout the day, the probabilities of them, having a big bounce, it's still possibly there, but it's just not as strong as a morning panic. Certain patterns like an ABCD pattern, at some market conditions, they may start to form between like 8:30, 9 o'clock Colorado time, but lately they've actually were, starting to form and break out later on the day between, 10, 11, 12, sometimes even later, but the averages are between 10 and 11 o'clock Colorado time again. And what I also do is I use the data to tell me when the averages of the time of day the pattern forms, and that kind of gives me an idea of when I should be looking for the patterns. And it doesn't mean that the patterns aren't going to form before the data says. I mean, there are some times where the pattern forms at, let's say, 8, 9 o'clock. But based off of the averages, it also tells me that there's a possibility that pattern may have a higher chance of failure. And when I'm tracking my trades, I do recognize that if they kind of form outside that time frame that's in averages, they may have a higher probability of failure. That's something that I have been tracking, and right now my success rate per trade is about 63% success rate, so it's pretty high. There are some people that have a higher success rate, but being able to determine when the averages of the patterns are and when the time of the day is, it's going to give you a little bit of statistical averages or statistical edge over the market. So the other thing is you want to wait for your patterns to form. One of the harder things about trading is it comes down to a lot of patience, and following a plan, a lot of it comes down to patience and just waiting and watching the markets. And so you want to wait for the patterns to form in the markets. No matter what, you want to actually only trade the setups that you're familiar with. And I do the same thing. I'll wait for the patterns to form and actually watch the markets. So random trading is linked into the reward side of the brain. That is a need that needs to be fulfilled. So a couple examples of that could be in a 9-to-5 job, of where the harder you work perceptively, the more money you make. So if you do overtime, you're going to get paid more hourly. Also, if you're doing a lot of work in the office or whatever type of job you'd have, it basically also means that you get to keep that job. Trading is the exact opposite. So the less you work in trading, oftentimes the more money you make. There's a lot of studying involved in the beginning of learning how to trade. There's a lot of education that goes along with it. A lot of it has to do with platform information, understanding how your platform works, understanding what a pattern is, understanding how to read a chart, technical analysis. But over time, as you start to recognize one pattern and you kind of just stick to that one pattern, you start to see other patterns a little bit easier in the market. It's a little bit easier to identify other trends that previously were completely oblivious to. Another thing is with random rewards is if there's some sort of need that you're not fulfilling in your life, if you're trying to use trading as a vehicle to get into something else, let's say real estate or modeling or some other avenue that you're more passionate about, the random rewards may actually be a way for your subconscious to bring out saying, hey, this is what I want to do with my life. If you think about any time that you've been at a job or maybe even been with a person that you were in a relationship with that you weren't really happy with what was going on, certain things would actually come up and in a way, self-sabotage yourself. You know, if you're in a job and, you know, you're kind of snippy towards your boss, you're rude to customers, you're not really performing very well, and maybe your subconscious saying, hey, you know, I don't really want to do trading, so if you do make money, it might make you feel good, but over time, I'm actually just going to cause you to lose more money, and eventually you may end up giving up. If that's something that you may be experiencing, is that, you know, you may have to do a little think about, you know, do I really want to do this? Is this something that I really want to do for my life? Is it for my career? And if it is, be prepared to actually be studying a lot. A lot of it is also mental challenge. A lot of it has to do with yourself. A lot of traders don't recognize that when you're trading, and especially trying to find consistency in the market, a lot of it has to do with self-reflection and your thoughts and feelings about yourself and your own self-evaluation. So if you do have a loss at random trading, it's easy that you can blame the markets, you can blame a guru, you can blame some person that you saw it on Twitter or some other information where you found it from. But when you actually plan the trades and you execute your plan, you know, the only person that you have a tendency to kind of beat up or to blame is yourself. When instead of actually identifying that, you know, each pattern, each thing has a random distribution between wins and losses. You may have that pattern 3 times around the market, and you may lose all 3 times. The pattern presents itself another time, and you think, well, this pattern is going to be a loser. I'm not going to take it, so I'm going to take this other trade that looks like it's going to be a lot better, and you end up taking it, and it's still a loser. Or you may take it, and it's a winner. But because it's completely random, you go, well, I knew something better, or it doesn't matter that it was a loss because I heard it from, you know, XYZ person, I saw it on Twitter, I heard about it on the news, and it kind of takes away your own self-accountability. Patience and waiting for a trade to form or for your pattern to set up the market is extremely hard to do. A lot of people tend to do random trading or executing a trade that they didn't plan out of boredom. And that's one of the biggest things that, you know, people have to overcome is boredom trading. I'm saying there's really nothing that I can see in the market that fits my criteria, but this one stock is up 30, 40, 50% and it just keeps going up. I'm going to take that because to them it thinks that there's a higher chance of making money on that trade. But because it's something that you haven't planned, you haven't identified, it doesn't fit your criteria of a trading setup, in all actuality you have a higher chance of losing money on that trade because you don't know where to put your risk at, you don't know where to actually take profit at, and if it's completely outside the scope of the way that you trade or your pattern, it puts you into a level of discomfort versus being comfortable and saying, hey, I recognize this setup, I recognize how this, you know, pattern or edge should perform. You're completely going into it blind and going, I kind of hope this is going to work. Kind of like if you pull the handle of a slot machine, it's exciting and fun, but if you lose in the market, you can lose potentially a lot more than what you're just putting into the market. You may also not have any plans or patterns that fits your criteria, and that's absolutely okay. If you think about it like fishing, you can go to the lake and you can be fishing, you cast in your line, and this happened to me on Father's Day where I cast in my line. Within a couple of minutes, I ended up getting a bite, reeled it in, caught a 7-inch rainbow trout. Cast it again 2 minutes later, ended up catching a 10-inch rainbow trout, and the fish were really biting a lot. It was pretty much every single time I was casting my line. Doesn't matter if I was using worms or power bait or a lure, I was pretty much just bringing in all these fish. But other times I've gone fishing and I can spend all day out there and I can see the fish jumping. I can try different lures, I can try flies, I can try power bait, I can try worms, and no matter what I do, their fishes just aren't biting. There's not even a nibble. Even though I can clearly see them in the water, it's not happening. And it's kind of like the markets of where you can see stocks are moving, you can see them actually doing stuff, but because they don't fit your criteria, it's like you're not getting a bite. You can say, hey, this stock is going up 20, 30, 40, 50%, 60%, but it's not actually giving you a specific pattern that you recognize and saying, hey, I know where to risk off of this, I know what the probabilities are on this. And if it doesn't do that, you just don't take the trade. It's like you're seeing the fish, you're seeing the stock in the market, but you're just not getting a bite on your line at all. So, at the end of the day, if there's no trades, it's like walking away from the lake and having absolutely no catch, no fish to take home. it's the same thing with trading. There may be days where there's absolutely nothing that's going to fit your criteria. So some of the things that you want to do to help eliminate the random trading or executing trades that you never planned are to first clearly and objectively identify your specific pattern or your specific edge in the market. Once you've identified that, you want to predetermine the risk off the trade. And most importantly, you want to be completely accept the risk and let it go if necessary. So cutting your losses quickly and intelligently based off of certain criteria that you've already predetermined before you enter into the trade. The next thing is every single time you see your pattern in the trade in the markets, you're going to trade it without hesitation or reservation. The reason why I personally do that myself is the pattern itself doesn't give you a guarantee to win. It just gives you a possibility, especially if you're tracking the information. It gives you a greater probability of your winning percentage. So for instance, currently I'm profitable 63% of the time. And I know that based off of, that I'm going to have about, 37% or something like that, where I'm going to have a losing trade. But if I'm willing to cut it quickly and I'm actually willing to get out the trade quick enough, I'm going to save a lot of my capital. I'm going to save a lot of mental capital. And the next time it presents itself, I'm going to be able to take the trade. Now, if you take that in consideration of if you're trading 3 times and your pattern has similar type of a statistical average as mine, and you're taking 3 trades, that means that statistically 2 of those 3 trades will actually work, one of them will fail. Now, that does depend upon the market conditions, but if you're basing your trades based off of the probabilities of the pattern, of the technical analysis, you have a higher chance of it actually being profitable. Now, there are some traders out there that, put a lot of emphasis on news, a lot of emphasis on different criterias. Again, I've kind of stopped doing that. I've completely gone away from the news. And the reason why I've done that is the news does form a bias, in my opinion. The news is nothing more than a sales technique. I've been in sales for a long time, and with the news, it's basically their PR department or other things trying to entice buyers into the market. Maybe they have a position or large position they need to sell. Maybe they have investors that also need to exit their position, so they need to cause volatility into the market. And so I try not to believe the news. I try not to even trade the news. I base everything purely on the technical analysis. And for myself, it actually takes away the emotional side. I have no idea why the markets or why that stock or the ticker or whatever the case is doing whatever it's doing. And I don't need to know why it's going to do that. All I need to know is, does this pattern work? Does this pattern present itself? What is the probabilities? Where I'm going to take a loss in case I'm wrong, and where I'm going to take a profit. When you predetermine your risk, you want to make sure that you completely accept the outcome of the trade, regardless of what happens. Now, if it does come down to your exit and you do decide to cut the trade, and I hope you do, and it decides to reform into a good pattern, and you can recognize, hey, this looks like it's actually it's reformed into another pattern that I recognize, or reformed into the same pattern that I thought it was before, you can always buy back in. It doesn't mean that once you've gotten out of it, you're done for it. You could always watch it and wait. There have been times where I bought into an ABCD pattern, the ABCD pattern failed, and a little while later it ends up reforming an ABCD pattern on the day. I buy back into it, and it does exactly what I thought it did the first time. So there's nothing wrong with doing that. Another thing is, when you do see your pattern in the markets, you want to actually act on your pattern without hesitation. Now, there are some criteria that I do actually look for. When I'm looking for a stock, I want to make sure that the past history does show that it has a higher chance of actually running pretty big. I want to have a big enough move on the market that when I'm buying into it like a breakout, it's not going to only go 2, 3, 4% and pull right back down. If I'm trading a stock like Apple and it has an average range of 5% and it has a breakout over a range, I'm not going to be holding on to it for like a whole month to get a 10% or even a 30% move. What I'm looking for is stocks that in the past have ran up multiple, maybe 30, 40, 50, 60, 70, 100+% on a day, and that tells me that there's enough volatility in that trade. That tells me that there's enough actionable traders that's in that market that's keep their eyes on that stock, that says, hey, I'm willing to bid this up or push it up higher, so that when I do get into those key levels, let's say a breakout, an ABCD pattern, they're also going to come into the market and make me a winner. So that's one of the criteria that I do have. I don't really have a whole lot of flow. I've noticed that flow right now doesn't really matter. So using predetermined data, I will pay myself as the market makes the money available to me. And basically the way that I do that is by scaling out of trades. Even with the $130 challenge, I'm scaling out of the trades. I'm using bracket orders. So some people think that with small accounts you shouldn't or you can't scale out of trades. I completely disagree. I do think that scaling out of trades does make it consistent so that as your account grows, you're actually getting the habit of trading properly. So that way, as you're growing your account and you're increasing your size, it becomes less traumatic for you to actually hold on to a position for a longer period of time. And it's also not so hard for you to actually deal with the fluctuations of the market. There's been times in my own trading career I may have a $500 position on, and I might be up, $100, and I want to actually see what the pattern is going to perform, and I might be just determining, say, okay, well, I think it's going to go up higher, or I want to see what the probabilities are on this. So if I'm in control of the trade, I may actually not scale out. So the market may reverse, come down, and that $100 profit is now $75 profit. And, instead of actually analyzing the markets properly and saying, this could just be a higher low, the market's still going up in my favor, you start to become more concerned about what the market is doing to take away your money versus going, the trade is still in play. If you're using predetermined key levels on the chart based off your data criteria, you can scale out the trade. So using the example of a 30%, if you wanted to, scale out at 10% increments, you can actually take it 10, 20, and 30%, scale out the trade, and maximize that data to actually get out of the trade with a profit consistently. Now let's say if the market, does actually come down to my stop out level, and the way that I trade, I don't actually remove my stop at all or increase my stop up to a higher part of the chart unless it forms a clear identifiable support level. But unless it does that, I leave my actual stop in the market exactly where it's at, where I first put it in there. Let's say it goes up and it reaches my 15% price target, comes all the way back down, it gets me stopped out, I'm still walking away with a profit. Now, with a lot of new traders, they're not scaling out of their trades, so it becomes really scary to actually trade. You're more concerned about, I have to make this a winner because I didn't take the profit on the last one, even though it may have made money available. And so you want to stay in the trade to either compensate for that potential that you could have had, so you want to stay in the trade longer, or you actually end up taking a profit too quickly and the stock continues going on in your favor. So by scaling out based off of data criteria, it allows you to take profits more consistently from the market, and also allows you to maximize the probabilities of your pattern and maximize the percentage targets that you're actually aiming for. And the other thing is that in the markets, anything can happen. Again, the patterns only present an opportunity to enrich yourselves. They're not a guarantee that's, what you're seeing in the market, it's a guarantee that that pattern is going to work, or that edge is going to work, or it's a guarantee that you're going to make money. There is always a random distribution between wins and losses with each edge and with each pattern. You just have no idea which one it's going to be. And the other thing is that every moment in the market is going to be unique. It doesn't matter what the pattern is, doesn't matter what people are telling on Twitter, it doesn't even matter if it's the same ticker that's done the same thing in the past. There's different players in the game, there's different emotions that's happening in the game, and there's no way to actually determine which each individual person is thinking, feeling, or believing is going to happen in the future with that stock. So every single moment in the market is unique, and by understanding that, when you're trading the patterns and you're trading your edge, that's one of the reasons why I take every single pattern that, if I see 4, 5, 6 different ABCD patterns, I'm not going to be choosy which one I'm going to take. I'm going to take every single one of those that I see. If I see, multiple breakouts in the day, I'm going to take every single one of those breakouts, and I'm going to still place the same criteria in every single one of those, because the probabilities are that some of them are going to reach my price target, some of them are actually going to reach my maximum price target, and some of them may fail, and that's actually okay. If you like this content, subscribe to the channel. Leave any comments or anything good or bad in the comment section below. Give me some big thumbs up to let me know how I'm doing. And share this video with any friends, any of your trader buddies, or anyone else out there. And we'll see you next time.